All right, good afternoon, or good morning, rather. We're delighted to have the Deputy Secretary-General, Amina Mohammed, join us, as well as to brief you here on the Financing for Sustainable Development report, which evaluates the global landscapes and makes recommendations for governments before the spring meetings of the World Bank and the IMF, which will take place in Washington. DSG, you have the floor.
Thank you very much. Afternoon, ladies and gentlemen. Well, let's begin with the 2019 Financing for Sustainable Development report. It's the result of over 60 entities from the UN and beyond, and it includes the World Bank, the International Monetary Fund, and the Organization for Economic Cooperation and Development. Despite our domestic public revenues in 80 developing countries rising in 2017, the report contains some sobering messages. Global economic growth has peaked at about 3%, while growth in wages is down to 1.8%, the lowest in more than a decade. Inequality is on the rise, and some 30 developing countries are in or at high risk of debt distress. Aid levels are stagnating and falling well short of the commitments that have been made. Private investment levels in developing countries are lower than they were in 2012, and while foreign direct investment flows are developing countries increased in 2018, they do remain unevenly distributed, largely bypassing many of our least developed countries. Furthermore, we see climate change continuing to threaten sustainable development in all our regions. The current challenges reinforce the urgency of adopting national and global approaches to financing sustainable development and fulfilling the promise of our 2030 agenda to leaving no one behind. We have 5 key messages that emerge from this year's analysis. First, that the multilateral system is under strain in a rapidly changing global environment. While this is forcing the global community to revisit existing multilateral arrangements, it also opens the door to make multilateral institutions more fit for purpose. Second, in response, the international community must recommit itself to action. Remaking the global financial architecture, for example, revamping the arrangements for sovereign debt, international tax norms, and especially the multilateral trading system. All this is a huge task, but it's certainly not beyond the means and expertise that we have. Indeed, discussions are already underway on all these areas. The question is, what type of system will we end up with? Rather than retreating from multilateral cooperation, we must strengthen our collective action to address global challenges in support of sustainable development. Third, global approaches need to be complemented by national action. We've put forward building blocks for countries to operationalize integrated national financing frameworks so their development strategies can assess the needed resources. National financing frameworks were introduced in the Addis Ababa Action Agenda, and it is time to start using them for sustainable financing on the ground. Fourth, achieving sustainable development and combating climate change require a long-term perspective. Public and private incentives need to be aligned with long-term sustainable development. This is calling for long-term indices, encouraging longer-term credit ratings, accounting for external costs through carbon taxes or similar instruments, and requiring more meaningful disclosure by businesses on social and environmental issues. Fifth and last, we must harness the potential of innovation to strengthen development finance. 500 million people have gained access to financial services in recent years, and in large part this is due to financial technologies. This has also made low-cost, prepaid or pay-as-you-go business models viable in sectors such as energy and has thus enabled progress in the SDGs. But it also creates its own risks that need to be properly managed. The report calls for rethinking of the focus of regulatory frameworks to highlight underlying risks, including from the growth of financial technologies. These issues are also highlighted in the Secretary-General's strategy on financing for the 2030 agenda. The strategy sets out priority actions to align global economic policies and financial systems in the 2030 agenda, enhance sustainable investments in regional and country levels, and seize the potential of financial innovation, new technologies, and digitalization. The Financing for Sustainable Development report provides the evidence and detailed policy recommendations to support the Secretary-General's strategy and provides financing policy options to our governments. The report highlights the need to combat climate change, including through public budgets and providing incentives for the private sector to act. We also need to combat inequalities using public revenue and expenditure policies, and also through shaping trade arrangements and regulating the financial sector. Gender issues are addressed throughout, as all policies, legal frameworks and programs need to promote women's rights and the empowerment of women and girls. In closing, I'd like to emphasize the excellent collaboration behind this report. The task force that produced it is an important mechanism for the UN to engage in a substantive dialogue with other international institutions. It has helped bringing more coherence on financing issues with the international system. The coherence is sorely needed. As the Secretary-General states in his foreword to the report, I quote, "The world cannot achieve the SDGs without a fundamental shift in the international financial system that enables us to address urgent global threats and restore trust in international cooperation." I urge the international community and countries to act on the report's recommendations. It's a good one, and I think it provides us with a tool that helps us to partner and collaborate with our governments. Yeah.
Thank you very much. And I failed to mention that we are joined at the podium with Naveed Hanif, who is the Director of the Financing for Development Office in the Department of Economic and Social Affairs. Naveed, welcome. Floor is open. Shauna.
My name is Shauna McGee and from Kyoto News, and on behalf of the UN Correspondents Association, thank you so much for taking time to brief us on this report. You mentioned so many things about the challenges to multilateralism, climate change, gender issues. How do we realistically change the global financial systems given this as a backdrop? And could you address the rise of extreme nationalism and how that factors in as well? Thank you.
Please, yeah. No, just if they.
Okay, great. Thank you very much. It is a very complex environment, and for a long time, flows have been going in one or two directions, and now with the universal agenda that we have, we find that the complexities and the partnerships that are needed do need to reshape the financial architecture. Discussions and convening and facilitating where that should, how that should happen. For a long time, the UN has been at the fore of that with our financing for development and building off the Addis Ababa Action Agenda. So I think here the impetus is going to be on bringing together those that are doing it in a way that actually responds to the SDGs, and I think our international institutions do, but not at the scale, and taking into cognizance some of these issues of inequality, of climate change, actually making it more conducive. What are the tools that we are using? We're seeing, for instance, that governments more and more are looking at the bond market. And in particular, they're using the tools of the green bonds for the climate agenda. But as we are using those tools to expand them to align not just what we need in investments for climate action, but also the SDGs, there is an alignment that is being made. And I think in the last 2 or so days, we did have constructive meetings with the UNFCCC and the development system on how we make those alignments. The second part of that question was on
nationals.
Yes. Well, I mean, here this is what we're trying to explain, that through the SDGs, through the numerous challenges that we have, many of which are cross-border, that it requires a joined-up response and that countries need to work beyond their borders in order to get the dividends of those investments for their people. There are many things that countries alone can't deal with migration, with climate change, the effects of the cross-border conflicts that we see. And so we continue to make the argument, but I think what is more important is to sit down and find the solutions together, and in particular in some of these regions where we have strong regional institutions, but we need to perhaps collaborate with them even more than we have done so in the past.
Edie, and then we'll go to the third row.
Thank you very much. Edith Lederer from the Associated Press. Many of us are not financial experts, and there's some language in here that I don't understand quite completely, and so I would like you to explain it to people who are not financial experts. First, your first recommendation says supporting a shift towards long-term investment horizons with sustainability risks central to investment decisions. In plain English, what does that actually mean? And also, the second recommendation, revisiting mechanisms for sovereign debt restructuring to respond to more complex debt instruments and a more diverse creditor landscape. The same for that. And in the final recommendation, addressing growing market concentration that extends across borders with impacts on inequality. What market concentrations are you talking about? And you say that global growth is expected to have peaked at around 3%. When did that happen? Thank you.
Okay, I'm going to say join the club. I'm not a financial expert either. But I am one that I would say, a practitioner in a country that has had huge opportunities for their domestic budgets and has understood that we are not, we exist within an international global financial system. So let me have a go at this, and then the expert sitting next to me will do better, I suppose, than we are. But I think addressing what we called the reality, readdressing the mechanism for sovereign debt. Frequently, that has not actually been tied to programs. You're getting debt restructuring. If you get debt restructuring, it releases a lot of fiscal opportunities for you to do other things that you would not have otherwise done. An example I would give is that freeing up $1 billion in one of our countries on a debt restructuring allowed us to do more in the social sector, spending on health, spending on water, spending on power, where we would not have had it before. And that, I think, is what we need to do a little bit better. Address the social protection floor, for instance. A lot of the time now we don't have the fiscal space for that. The challenges are huge when we look at some of the indices on poverty. And so how can we tie it more to some of these negotiations that are had? In terms of when global growth peaked at 3%, Naveed, you're going to do that one. And other than that, I think that the concentration of a lot of what we see in our markets, quite frankly, has been in one or two parts of our world. And what it needs to be is better distributed. For that, you will need investments in infrastructure. You will need investments in better financial systems to allow trade to happen better and more equitably, but also to find the capacities for us to engage in that. I think one of the perhaps most forward-thinking negotiations that we've had has been on the African continent with the Common Free Trade Agreement. But that has raised a number of issues as to the capacities and the span of time that it's going to take to roll that out. Within Africa, I think there's lots of opportunities and enthusiasm, but we also have to know that many African countries are also in agreement with the EU, with the US, and so the alignment of that will take some time, again, addressing the concentration on markets. Not sure that it made too much sense, but that's my layman's version.
Thank you so much. This question really hit the nail on the head. Let me begin with long-term investment horizons. The report is very explicit that the current system of investment, because of incentives and regulations, is designed for short-term gains. Look at quarterly reporting. You have to show earnings. You have to show performance to the investors, shareholders, that the company is producing earnings at a very fast pace. Second, when you are investing, when you are an asset manager and as asset owner, your time horizon is very short. The report suggests a number of measures that can shift the behavior of both investment owners and managers to look at long-term returns. And that requires incentives by governments and change in regulations. That's the kind of change we are asking for in this report. Second question, debt restructuring. The sovereign debt landscape has become very complex. And I will give you just two examples. There are new lenders now who are not members of the clubs that existed before. So if there is a challenge for a country to restructure debt, they have to deal with all of those new actors. And the report is suggesting there is a need to rethink the multilateral arrangements. When a country runs into debt problem, how do you restructure so that all actors are sitting around the table? And that's a very significant recommendation because there is a growing demand for this kind of shift. Market concentration and inequality. I will give you one example which is very day-to-day you are living with, and I won't go into country detail. In this country, 40% of the retail market is being run by one company now. And that determines your wages. They hire, they determine your wages. And one of the reasons wage stagnation is market concentration. Because the old analysis of monopoly power, which was you always looked at the wages, the prices. If prices were manipulated, you would say it's monopolization. Now you get lower prices, but still one big actor is running the market. So that's where we are talking about inequality because of market concentration. Few actors are calling the shots, and you need to rethink the rules and regulations that exist to make sure the monopolization doesn't happen. 3%, there have been downward revisions on global growth trends the whole of last year by the IMF, by the UN. And if you look at the statement given by and this is a separate issue, head of WTO 3 days ago, he has also said trade is going to go down. It's a 1% revision over the last 1 year in trade flows issued by WTO. So these are the factors we have highlighted in the report, but we are available. My colleague Sherry is also in this room to respond to your very specific questions. Thank you.
Thank you very much for that explanation that helps all of us. Yes, please go ahead.
Ellen Wolfors with the Thomson Reuters Foundation. First of all, I want to thank Edie for asking that question. There's implications or more that this threatens the success of the SDGs. It's mentioned in the statements. Can you elaborate on that a little bit? I mean, are the SDGs at risk of failure if this remains the status quo?
Absolutely. I think that, we have made over and over again, every fora that we've had on finance, an alert that says the flows that we need to come to domestic markets in international collaboration, opening up the billions to trillions. If that doesn't happen at scale, then of course the SDGs will be at threat. There are major investments that are required for the SDGs. When you look at the goals from 7 to 15, we're talking about infrastructure and energy, cities that are going to grow at exponential rates. Yesterday, I was listening to proposals for floating cities, which are a reality when we look at the climate agenda, coastal areas, that the money that's going to be needed for those kind of investments is also huge. I think we have not yet made the connection with the opportunity. It's almost as though they're not convinced of the value proposition of the SDGs. And I think this report goes a long way in trying to show the how, not just talking about what is the problem and we continue to say we need more, but how we really need to open up those opportunities that will increase jobs, revenues to pay for services that will that countries ought to have. It's very difficult to put a country in a position where they don't know whether they're going to spend on health or on education, and you're asking them to borrow for a service. That's as bad as it gets today, is that you have these health programs and education programs which actually a country should be paying for. Why are they not paying for them? They don't have the revenues. The revenues they ought to get from their economies growing, investments made in infrastructure to allow them to grow, to industrialize, to create the jobs that are necessary, and the revenues to pay for basic services in I would say you'd see in goals 1 to 6, from social protection all the way through to delivering health and education. So I think that we're asking now how much more clearer can we be with the value proposition. I think the implications of not investing will cost everyone. We are seeing an increase in migration that costs. We are seeing that people are not able to eat. In fact, today I've just been listening to the trend that we are losing all the gains we had on the hunger goal. And that's, creates all sorts of instability. And people are hungry, they've got no hope. Then we know that they're fodder for many of the conflicts that we see around the world today. So I think we do have a value proposition. We have the solutions. We've not made that connection yet. I hope that the visit that we have today, this week, next weekend, to the World Bank spring meetings, we have a number of interesting tables that bring together finance ministers, for instance, on climate. This has happened for the first time last year in Bali, where the Secretary-General engaged with them. Again, it was actually spelling out to them what a pipeline looked like that they really need to generate investments for. And when we talked about the pipeline for the Paris Agreement and the NDCs, it all sounded sort of, that's another charity. No, it's not. In that pipeline is green energy. In that pipeline is green transportation. These create opportunities for industry. These create opportunities for young people, for technology, for R&D. So I think just continuing to do more of that, connecting the dots, facilitating better where those flows could be directed to. But as Naveed said, some of the financial architecture has to change. It does have to be long-term because you cannot invest in short-term for infrastructure. It's a long-term investment with returns that we believe will lift the 2030 agenda. But I will say that today it's not in good shape when we talk about financing the SDGs.
Linda.
Thank you, Steph. Thank you for being here and clarifying some of this information. My question is this. The report also mentions that there is some good news. And one piece of good news, it says that 75% of individual investors are showing interest in how their investments affect the world. So I was wondering if you could expand a little bit on that. For example, who are these investors, how many of them are, and where they come from?
I think both from the investment community, we've had BlackRock here a number of times, and they hold a huge share of the market, and they are taking at the core of their business models the sustainability principles, and that for us means that they're becoming much more aligned to practice that we'd like to see for the SDGs, and they are investing in them, and they're investing in encouraging smaller entrepreneurs to get involved in financing the SDGs. We've seen social impact bonds. In fact, the bank has had SDG bonds that they have issued, and this has also helped. So the investment is happening in a number of countries that way. It needs scale. There's lots. We are littered around the world with good pilots. But how do we get the hook to take that scale, take these investments to scale? And I think that's still a challenge that we're left with.
Maggie, then Carla, and then Joe.
Margaret Bashir with Voice of America. DSG, you mentioned the financial architecture. What kind of reaction are you getting from governments and from private sector on changing it? Because are they receptive to the idea, or are they resistant?
I think there's been a lot of listening, and people nod. But how do we connect that with actually looking at countries like, for instance, middle-income countries? When you have low-income countries graduating to middle-income countries, and suddenly the needs that they have remain the same, but access to finance and those markets suddenly becomes closed to them because of that level that they have moved to. So that's sort of like graduating to penury. And people nod that this is right. You're right, absolutely. There's inequality here. There's still issues where people are not accessing markets. They need infrastructure. They need investments. But there is this nomenclature and everything by GDP that makes it very difficult for them to move. So we see that there is some willingness to address this, acknowledging that it is a big challenge. Where are we seeing the inertia? Why are we not getting beyond that? Perhaps what is useful to see is that as we look at the vulnerabilities of some countries who are middle income and they face climate disasters. The minute we have those disasters, we open up a space for engagement and we move the needle a little more towards getting access to some resources. But it is short-term right now. What has happened in the Caribbean is short-term. We need a much longer-term fix for that. And I hope that as we continue to plug away at the tables that are opened up to us with finance ministers, it begins to make more sense that this is actually in their interest and will cost them less in the longer run.
Carla and then Joe.
Thank you very much for this very honest briefing. And I appreciate the fact that when you and I met, you stressed the fact that the global financial system needs to change. I have two questions which may seem impossible, but they may ultimately become inevitable. The contributions or cooperation with the SDGs is voluntary. There was once an effort to create an economic social council at the United Nations which would mandate economic investments. I understand the United States opposed it. But this may become a necessity, just as the Security Council, to prevent. What are the chances? I mean, is there any chance of working in that direction? And secondly, I don't go to Hollywood films, but there's an excellent film that I would recommend that I just saw, that Hotel Mumbai. And I know when the Security Council met and President Mesic of Croatia, this was 2008, I believe, after the bombing of the hotel, what it made clear was that the terrorists came from the most impoverished and destitute areas where there was no hope. And they attacked a seemingly impregnable, protected, massively opulent hotel. What came across from that film is there is no defense against 8 desperate people who can...
Carla, if you could just get to
the
question.
question is, you need to motivate countries to take the Sustainable Development Goals as an imperative. And if they realize that their survival, the health and security of the 1% that controls...
Carla, please, just a question mark, please.
There are silos at the UN. Why aren't connections made between the fact, because this was something that President Mesic, that unless there is investment in the SDGs, the most privileged people will be threatened and endangered. And you may be able to mandate investments with sufficient
Carla,
motivation.
I beg you, please, just a question.
What are the chances of any of this being considered and taken seriously?
Well, we certainly don't give up. I think we never would have got the ambition of the SDGs, Agenda 2030, had it been a legally binding framework. I think the fact that it was voluntary and it is non-legally binding says a lot to the possibilities and the ambition we needed beyond the member states in the United Nations. This is about private sector, it is about civil society, communities. And so I think this is the best framework with the ambition that is doable, that was a 4-year conversation with everyone inputting. So I think we've got a good framework. I think that it is right that it is not legally binding. There are many other treaties and conventions that strengthen this framework, and I think that's how it should be. I think the collaborations and the responses we've seen from all member states on the VNRs over the last 4 years in this space has indicated full engagement from governments. I mean, people are engaged in this universal agenda, but there is still the disconnect on the means of implementation. The scale at what we are attempting is not just one aspect of development. It is a paradigm shift that moves from just doing the incremental spending on health and education to whole systems and budgets that need to be connected with the international financial system. And that's what we're working towards. We've talked about it for so long. It is complex. You are talking about tax systems. You are talking about fiscal space and macroeconomic policies that need to be better joined up. So it will take some time, but this is why we have reports like this. It's why we continue to meet with experts, continue to meet with the players, and to try to change the direction of their travel when they talk about investing in development. That it's about sustainable development. It's about the long term and not just the short term fixes. I haven't watched the film, so couldn't help you there. But I will say that the UN is trying to be more fit for purpose in helping to be more joined up at the country level in response to countries' needs. And so really providing the technical expertise, working better with the bank, with the EU, with other bilaterals, which we haven't done before. It has been a fragmented approach, and it has not been sustainable development. It's been the MDGs. So again, our regional economic commissions, our UN development system are working much more closely together. To the point of, the root causes, the reforms happening in the peace and security side of this House are having a positive effect in providing a better information and backdrop to what we do on development. So the SG's lens on prevention and transition are a big part of us trying to signal the enabling environment for investors to come in many of the countries which are conflicted or have crises.
Thank you. Joe?
Yes, Joseph Klein, Canada Free Press. Pardon the voice. I feel like I'm cramming for an exam here and trying to look through this. But two quick questions. Number one, in your section on progressivity of taxes and revenues, what do you consider empirically, if you've analyzed this, to be a, quote, fair progressive rate at the upper levels? Because this section seems to criticize the decline of tax progressivity in developed countries over time, and also the difference in taxation of capital investment at a lower level. Do you think that should be at parity with wage income? And the question about the retail concentration, I'm assuming you're referring to Amazon. But all right, we won't name it. Explain to me how achieving lower prices through economies of scale that consumers pay is contributing to inequality.
This is where the DSG gets to lean on the technocrats.
It's wage stagnation, because if you are looking for a job and there's one employer, there's wage stagnation. So that's what I meant when I said market concentration gives you higher power to negotiate, and then you can dictate the wages that you give to your employees. That's one way of raising inequality, through market concentration. We do not recommend any tax rate, what is the best rate to tax in a country. It's a national decision determined by governments depending on their economic and political choices. Our position on taxation, because the UN has been a big advocate of global coordination on tax policies, in that vein we have made a series of recommendations, not only in this report, in our other reports, what can be done. For instance, base erosion and profit shifting. Companies are avoiding taxation where taxes are high, take their profits where taxes are low, and in the end, host countries end up losing revenues. So we need to fix those loopholes. The new frontier, because there was a question asked, is the world ready for changes in the international architecture? In the area of taxation of digital economy is one frontier where the world is really approaching it with an open mind to find a solution. There's no global agreement yet, but it has changed the economic theory of taxation, which used to be on physical presence, which is not the case anymore. You can generate tons of revenue not being in a country. So these are the new frontiers where global stakeholders, including governments, are very open to go for major shifts in the way global system is shaped. I see that also in the area of debt. I had not seen this kind of opening before, multilateral platform on debt restructuring, which shifts from the clubs that exist. Third area, trade. I mean, there's a clear agreement, multilateral trading system has worked, but it's time to reform WTO. So there's an openness to bring these changes in the global architecture. Thank you.
Thank you. We'll close it. Thank you.
Following up on Joe's question about taxes, I understand that there are quite a number of countries that don't collect taxes from individuals on that level. How significant is that in terms of not raising the funds for the countries, not contributing to improving conditions?
Quite significant. I mean, in many countries, not having the levels of our domestic resource mobilization at where they should be has got a lot to do with how we tax the individual, the companies. But when you're not providing a service, again, coming back to the individual wants to know what they get back for that tax. And in many of these countries, there are so many different levels of service provision that it doesn't happen. And so there is a what's the word for it? A complete lack of incentive for anyone to pay their taxes. And there are not sufficiently strong institutions that would be able to chase this up or to do the tax education that you need so people can make the connection between when I pay my tax, this is what I get in returns as an individual. And I think we have to work on with countries on that, but on many fronts at the same time. I think you really do have to see better health services, education, access to education, services in water and sanitation before you even begin as an individual to feel that you have a commitment to that tax. And that, I think, is across many, many countries. I mean, probably even in the developed countries as well, people are questioning what they get for the tax they pay. So it's a continuous effort at trying to do that, but it does mean that we need to strengthen our institutions, and we need to make sure that governance is attended to in a real way, because many, even when we come to social protection programs, there is still a gap in trying to ensure that what is meant for the poor and the most vulnerable does not get there. Again, that again is a big challenge that we have.
Thank you very much, DSG, and thank you very much, Naveed. Thank you to you, and we'll see you in about 20 minutes for the briefing.